welcome to this discussion that PCD is proudly hosting on ESG and private clients. We've got a stellar panel lined up for a discussion this afternoon, which is going to bring you the latest trends from this sector from a whole variety of perspectives. As usual with these weekly sessions, we have an audience of PCD members with us on Zoom. We also have an audience with us on YouTube. Both are welcome to submit questions, which I'll bring to our panel at the next available opportunity for me in the discussion. So as always with PCD, we love to hear from our members. Let us know what you're thinking, your questions for our panel as we move through the discussion today. At around 10 to the hour, we're going to cut the feed to the live stream, and we're going to finish off with some networking with our panel and a live Q&A. So looking forward to the hour ahead and hope you enjoyed the discussion too. So just to open up the discussion, I'm going to come first to Melanie Griffiths from Equiom in London. Welcome, Melanie.
Hi.
So, Melanie, you've made the transition from working in the banking industry to now into the fiduciary space. It'd be great to get your perspective on how you see ESG in light of your banking background, but also in the fiduciary sector, what your sense is of the demand from clients versus the provision of advice from the industry.
Sure, of course. So as you mentioned, my background is in private banking, where I was 15 years at JP Morgan, and I very much saw the ESG landscape evolve in that time, where probably the first queries we had from clients was about 10 years ago, and they tended to be charity clients, where we were managing a portfolio on behalf of a charity. And I remember making some inquiries internally, and it was very much ESG, that's not something we do, you know, it's on the philanthropy and no interest there. Quite similar to crypto, actually. To now, JP Morgan is a very prominent leader in the ESG space. So it's been quite interesting for me to see how the landscape has evolved. And when I joined Equiom, because of my investment background, I was naturally invited to join beauty parades, where essentially investment managers pitch for trust business. And I had never seen anyone other than JP Morgan pitch. So I was quite intrigued when I saw every single manager have a big ESG feature very prominently as part of the pitch. To the extent that I went back, because I wasn't part of the initial discussions and the brief, I said, well, what was ESG part of the brief? And I was told, no, these days, every single manager incorporates ESG into the pitch. But what struck me is that none of the managers actually asked the client whether there was any interest, whether there were specific things they cared about, whether it was something, you know, was there particular causes, was it, I don't know, plastic, biodiversity, gender equality. There was no discussion whatsoever. And it surprised me a little bit to see how much there was talks around ESG, because in my tenure at JP Morgan, other than those charity clients, not once did I see a client inquire about ESG or wanting to invest in the ESG space. So I thought maybe things have changed in the few months during the transition. But I went back to the trustees and I asked, look, what are we seeing, us as fiduciary? And the overall feedback was that overall demand is reasonably low. We're not seeing that much demand from private clients. Yes, we are seeing a few policy investment statements where there is a mention of ESG, but generally the demand is relatively low. Where there is an interest, quite often from a next gen, we have seen parties to a trust walk away just because they found the whole landscape and very complicated and confusing. And indeed, when I was sitting sort of on the other side of the fence now as a client, and I heard investment manager pitch to us, there was literally an instance where one day there was a particular name that was the top pick of an investment manager. And the next day, we were told that same name was excluded on ESG grounds, just two different managers. And I won't pick the name, not to pick on anyone, but Tesla is a great example how, if you're looking at it from an environmental perspective, it could score quite highly on the ESG front. But if you're looking at it from a governance perspective, it might score quite low. And so overall, this is quite a confusing space for private clients to get to grips with. And I think the feedback was very much that it tends to be more supply stroke investment manager driven, supply push, rather than private client demand pull. And I think within that context, it's important to look at the motivation of private clients to want to invest responsibly. I call it responsible investing because it covers several things. I think one angle is reputation. Similarly to tax, where increasingly the difference between tax planning and tax avoidance may be morality. We get more and more questions around, sometimes there are things clients can do, but will it attract attention? Is there a reputational risk? And I think from an ESG perspective, we are going down that route where if private clients are not perceived as investing responsibly, they are carrying a reputational risk. However, it's important that each family has a different set of circumstances and reputational risk. We've all seen the backlash when Harry and Meghan were sort of flying around the world on private jets. And, it's very personal to a family. What is their background in? If you've made your wealth in, let's say, farming and growing cattle, and you're suddenly investing in all sort of non-meat food products, again, from your family's perspective, there could be a reputational risk. Then the second reason is investment returns. I think we also, during the pandemic, clients and companies that were strong on the ESG front performed better because they were more on top of their supply chains. And so when the pandemic hit and supply chains were disrupted, they were able to very quickly identify alternative sources, etc. And I think the direction of travel is such that companies who are not ESG friendly will end up paying more taxes. It will cost them more to borrow. The cost of capital will increase. Potentially a lot of regulation is coming our way and the compliance costs will get increasingly heavy. So that for me, from an investment perspective, ESG makes a lot of sense just because it's a bit of a self-fulfilling prophecy. And I personally, I don't get the whole lower return argument. I know it often comes up as part of trustee discussion that often clients walk away when they see the lower returns. For all the reasons I've outlined, for me, in terms of investment benchmark, I think it should be exactly the same as a balanced conservative or growth portfolio or equity only mandate. The problem is more the lack of measurable impact benchmark. How much good is this achieving and how can you compare it to another company? So that's the second reason. There's the reputation, then there's the investment. And the third reason is those who actually want to do good, who genuinely care, who are very passionate, and that tends to be the younger generation, not always. And there, the problem that you face is that often it's driven by values for the family. What do they care about? Again, is it biodiversity? Is it plastic? And then when they see the names in the portfolio, there's a bit of a mismatch in terms of expectation. So for instance, recently there was a large retail investor which came out with their top 5 ESG picks, the 5 names. And it was Coca-Cola, which could be quite a controversial name given, there's obvious problem with diabetes and sugar, and it's not great for one's health. British American Tobacco, who grow crops very sustainably. But again, it could be a bit of a surprise for a private client who really cares about ESG and find that actually they invested in British American Tobacco. And I think there was a couple of pharma companies presumably benefiting from the action of the former two. But again, there's so many lawsuits, etc., against pharma companies that from a sort of value, it just does not match. And I think it's important for private clients to remember that when managers look at the landscape, they tend to look at the impact that the environment and society could have on the company in terms of rising insurance costs, etc., versus private clients. They care about the impact a company is having on people and planet. So they come at it from 2 different angles, which can create this mismatch. So I think there's plenty there for other panelists to have different viewpoints and to start the discussion.
Thanks a lot, Melanie. And I'd just like to bring in Kristina Church from Lombard Odier Investment Managers. Welcome, Kristina.
Hi, David.
There's a lot of definitions within this space that's thrown around quite interchangeably. Perhaps we could just kick off by just you setting out how you see the differences between ESG, sustainable investing and impact investing on a spectrum.
Certainly, and it also goes back to many of the points that Melanie made that really resonate in terms of how much this space has changed over the last few years. I remember, my background's in banking as well, and in particular in the automotive sector, so I'll comment on Tesla as well, wrong true, but like 15 years ago, writing about carbon emissions and how that might impact valuations of stocks, nobody in mainstream investing wanted to know about it, but there were a team of socially responsible investment analysts who might be interested, but it was very much seen as a sideline. This is a nice to do, but it's not a generator of returns. And then having watched the changes that's driven and the drastic change in valuations in the sector over the last decades that really have been driven by climate and emissions. But coming back to your question on the definitions, I think that really encompasses it. ESG means different things to different people. And that's where it's incredibly important to really understand what our clients mean by the terminology and what our clients want. And I think one of my colleagues, Dylan Samuels, is in the audience today, and I know he will agree with me that there's a huge inbound demand now, so much more than there was historically, from our clients to invest sustainably. But does what that means to each client mean the same thing? And there is a spectrum of ESG, starting at exclusionary investing. Now, for us, that's quite a simplistic way of investing because it misses the need for transition and the need to invest in some industries that may be bad today, whether that's bad in terms of climate, carbon intensive, but that are vital to economic growth for the future and really need to transition. And if you're just excluding and taking capital away from some of those areas, I think that's where this connection that ESG investing means no returns. Well, if it's done in a more simplistic way, that can be the case. And then you could, moving on the spectrum, you get more integrating ESG metrics. And I think, again, there's issues here. Third-party data providers all provide different views. As Melanie mentioned, say Tesla as an example, you can have one data provider that gives E a greater weighting and they can see Tesla as an A+, and another third party can mark them down as a D because they give governance more. And so it's very much up to investors and to understand what they mean by some of these metrics. But also ESG metrics do tend to be backward looking in nature. And in order to understand, in our view, full sustainability, you have to look forwards and you have to think about, is this company sustainable for the future? And that's where you can start to think about opportunities and returns, in my view. Can this company, when you're investing in it, really focus on the challenges for the future? And what are those challenges? And then at the furthest end of the spectrum, you do have impact philanthropy investing, where historically there was, a view that there wouldn't be returns associated, but there was an ethical considerations and wanting to do the greater good. But we certainly see ESG nowadays as becoming much more mainstream, and also a break from this idea that it doesn't generate returns. We do think if it's done in a forward-looking manner and without simplistic exclusions, then you can start to generate returns and identify the best positioned companies.
Okay, many thanks for that, Kristina. Michael Strachan, just to bring you in from IAM, you've developed a framework around looking at this, looking at costs and returns of ESG strategies. Perhaps you could explain what your typical findings are of that framework.
Yes, well, good afternoon, everybody. And I think the first two speakers kind of created the concept of complexity, and it's an immensely complex area at the moment. And I always kind of have the analogy, which it took the Florentines nearly 600 years ago to develop double entry bank accountancy practice, and we still haven't got it right at the moment, and that's the problem, because we've got all these myriad factors. So we might go to sustainable development goals. We've got 17 of those. What does gender equality mean? We know what it means, but its interpretation in different environments is very different. What does no poverty mean? We can actually assess, say, carbon and the implications of carbon. That's something we can grasp hold of. And that's the central problem that our clients will be starting with. And we're somewhere in between the fund managers, who's the fund managers, and the net asset owners, who are probably the trusts and the big institutional funds that are available there. And we're sitting in between as the advisors. And we have to be responsible in creating something that is practical and pragmatic in how to dealing with this very complex environment. Now, one of the problems is that we don't have a taxonomy at the moment to define standards at all. Governments are working for them, and those are increasingly suspect at the moment. We don't want to see a regulatory framework. Most managers are developing, as we've mentioned, to greater or lesser extent, a sustainable approach. And that's great, but they're all very different. I mean, we were talking about Melanie being exposed to different approaches. If you get into great detail about them with our in-depth relationships with managers, we will find that their definitions are very different, let alone the third party. And we talked about Tesla, where there's two leading third-party providers come out with very different conclusions, even on something as basic as Shell, where one would think the conclusion is fairly obvious. So how do we bring this all together, including the client? And I'm going to be rather controversial here and saying the client is probably the worst person to ask about this, because he might come out with the ideas, but as we'll see, no doubt, when we're in a discussion about the legal background, if you've got 4 beneficiaries, they'll have 4 different interpretations. And I think nuclear power is the classic example. One person thinks it's the perfect solution, and the others think it's anathema. And how do you get that together? So what we're trying to do is actually combine this into a framework, which means that we are actually demanding certain basic standards out of anybody that we operate from, and then have an enhanced ESG sustainable investment protocol above this. So we've established a ground hurdle that everybody needs to meet. We're then posed with the problem that we actually have to check to see that they're meeting this, and that's a challenge, and that what they're meeting is doing good in the long-term return. And we're going to try to measure impact, but this must be a 5-year project, simply because in so many elements it's not being properly defined at present. Carbon is probably the most important element, and that is something where we're going to be able to get an idea of a carbon footprint. And we're working towards that. So essentially what you said to the client is, look, let's not go on the exclusionary principle. Let's not go on to the principles of thematic investments that you like. Let's go on a different way of creating a portfolio of investment managers, all to a greater or lesser extent, and we're looking for those who are a greater extent, aiming to produce a return stream that is positive and control the risks that I think are going to become increasingly apparent in people who are not pursuing sustainable investments. And that's the best way forward. And we can do that very simply and effectively.
Okay, thank you very much for that, Michael. Chris Moorcroft, just to bring you in, I mean, we've heard of the complexity, we've heard of the pressures there on trustees trying to navigate this space. How do you help trustees understand the risk they might face in the future? And building on that, what do you think kind of reforms, what legal reforms are necessary to help support this important and growing area?
Sure, thanks, David. Well, I mean, first, just building slightly on what the previous panelists have said, you know, as a lay person in an investment sense here, I'd like to add my voice to the chorus of those saying that the area is a pretty bewildering one, and the number of different metrics that can apply, and people's subjective opinions of those metrics, and the number of banks and investment managers out there saying different things does make this whole area very, very confusing. I think I see a lot of clients, including trustees, who are on board with the general principle that it is a good thing to direct capital towards companies and projects which are good, but then defining what good means is extremely difficult. And frankly, at the moment, the area is a little bit sort of Wild West. And we're hearing a lot about greenwashing now. It's very difficult to know when you're dealing with parties in this space who is really authentic and who is not. And on that, I think, it's really important to have people like Michael performing the role and helping clients kind of wade through this, and also, without wanting to be too sycophantic, but with Kristina and Dylan on the panel, I think I should say that Lombard, Odier do seem to be extremely authentic. And I think the B Corp badge here, and that's something I might touch on when I'm talking about legal stuff, and the B Corp badge here is a real sign of that authenticity and is an interesting way in which the law is going. But now to actually answer your question as the trustee and fiduciary risk, I mean, yeah, there is risk for trustees. I don't shy away from that. And it arises simply because the ESG is, for a lot of trustees, a relatively new concept. And it incorporates metrics that are not purely financial. And so from a fiduciary risk perspective, even if a trustee makes an investment decision to go into investments of an ESG compliant type, and does so purely on financial basis and nothing else, on the basis that they think that's going to be the best investment from a financial return perspective, even if they do that, there is still some element of fiduciary risk if things go wrong, simply because a beneficiary and a good trust litigation lawyer will point the finger after the event and say, but aha, that was an ESG investment. And we think that actually you were taking into account factors that you might not have done, or perhaps should not have done. And so for that reason alone, we do have this fiduciary risk point to address. And there are various ways of doing it from a legal perspective. Guernsey Finance have put out a very good document, and I would encourage people to have a look at that. Where they suggest clauses that could go into trust deed. There's talk about indemnities. There are even particular structures that try and drive fiduciary risk away from the fiduciary. So private trust companies, certain types of purpose trusts, things like that. The problem with all of this stuff is, firstly, that it's quite reactive. From a trustee perspective, it's a case of responding to beneficiary requests to think about ESG, and then working out how to deal with the fiduciary risk issues. So it's not really the trustees getting on the front foot in this area. But secondly, there is this barrier that needs to be overcome, this fiduciary risk barrier, which I do feel is holding trustees in the offshore trust world back a bit in fully embracing this area. Now, I do think there will be change. I think there are very clear examples out there at the moment of how the law is driving change and incorporating environmental considerations in a way that hasn't been done before. The law, as it has done for centuries, evolves. It's this wonderful evolving thing that changes as societies change, as views change, and it is changing as environmental considerations in particular come more to the fore. So just in the last few weeks, there's a really important case in Germany where the German court basically turned around to the German government and said that you are not being ambitious enough on reducing carbon emissions, and that effectively deeming the law that the German government was bringing in unconstitutional. And then more recently, last week, in fact, a hugely important case in the Netherlands where a Dutch court has ordered Shell to cut its carbon emissions by far more than it was planning to do. And it did so on the basis of saying that Shell owes a duty of care to the citizens of Holland to reduce its carbon emissions and effectively to protect their human rights. Now, what this tells me is that the law is going to be an incredibly important tool in driving change. At the moment, in many ways, it's a barrier. So when we talk about these fiduciary risk issues, they are a barrier to certain people, certain institutions, not just private trusts, pension fund trustees, fully embracing this area. But I think in time, those tables are going to turn, and we could see some really, really interesting cases as well as legislation in various places to actually make the law a tool that nudges people towards shifting capital towards good, whatever that means. And the final point I would just make on this is to say, when it comes to the offshore trust industry, I do think they have a choice here, which is either to go along with this, as I think will sort of happen naturally, or to get on the front foot and actually legislate to try and tackle some of these fiduciary risk issues. That's what I believe should happen, but I know that's not a universally held view.
Okay, thank you for that, Chris. Very helpful. Roddy, Balfour, just to bring you in, I mean, what's your perspective from the trustees' view on what some of Chris said there and what we've heard so far in the conversation? Roddy, you're just on mute there. You're still on mute, sir. Roddy, if you want to unmute, in a way you can.
Yeah, Chris is the lawyer. He's looking forward to writing the law for the offshore jurisdictions, which will be 1,000 pages long. I've got a magazine here, the Journal of Sustainable in Finance and Investing. What date is that? 2014. It's full of articles about everything we've been talking about. I told Melanie the other day that when I was in private client stockbroking more decades ago than I really want to publicize, we had endless manila folders on which was written no drinks companies, no tobacco, no gambling, things like that. People already in those days felt very responsible about what they did. Now, a few years ago, when we had beneficiaries who came in and were in the vanguard of this, saying, I don't want to invest in this, and I don't want to invest in that, I don't want oil stocks, it put us as trustees in a difficult position because they were effectively potentially going against the advice that somebody like Lombard Odier would have given us in those days. So we would have been outliers. What's happened, which is wonderful for trustees, is that Shell is a brilliant example. Regulation is making Shell reduce its carbon footprint. QED, presumably, that is a stock that we can go into with impunity. You've got all this, you've got the companies who are under pressure to pursue ESG policies, which is happening across the board. And then, bliss for trustees, we have the likes of Michael and the investment managers who all have embraced ESG. I mean, ESG is like charity. Everybody loves it. There's nothing you can argue against about ESG. And so, I don't think as trustees, and we're not paid enough money, frankly, to start screening every manager for a whole lot of variables on ESG. I mean, let's rely on the investment managers and the companies they're investing in. I mean, the other day we looked at a fund and it had Ryanair. And we said, carbon footprint. And they said, well, we bought it because we think the airline industry will rebound and Ryanair will be the most fuel efficient per passenger mile in the world. So I mean, I don't want to take up too much time because other people have got more interesting points, but I do think that trustees have had a huge burden lifted from them by the fact that this is mainstream and we do file notes. And remember, trustees don't have to be right. We're asked all day long to do something which may not be profitable in the end. We just have to have considered it. And I think, Chris, you will know as a lawyer that that is the biggest vulnerability for trustees, is they do something just, you know, because they're told to, asked to by a beneficiary or a settlor. Like, you know, I'd like to put 50% of the trust fund in a new wind farm, and it turns out there's no wind where it is. You know, that's a different matter. But what you might call what this discussion about, which is broad brush investing, you know, I think we've got a solution. And I mean, I think the other thing is that costs versus returns is, you know, for a lot of people, ETFs are the answer. And there are ETFs. I mean, there's the Legal and General, what's it called? I did write it down because I knew I'd never remember. The Future World ESG Index. So you buy that. Are you going to monitor whether it really is very ESG? But you're getting much lower costs. You know, you've got trackers. What about when you buy life insurance? Are you going to start saying to the insurance company, I don't care about my premiums, I want to know where the money's invested? I sat on a very large endowment until recently, and because we were an eternal charity, we put the whole lot in an L&G FTSE 250 tracker for cheapness and everything else. Well, we can't tell L&G that some of the stocks in there we don't consider to be ESG friendly. So just to close off, my point is that industry and the investment management side of things have taken a huge burden off trustees.
Roddy, I'm going to come to Kristina and Michael in a sec. But Kristina first. Roddy mentioned there, looking at this from a sector by sector view. I mean, where do you find there's value, there's attractive companies for sustainable strategies, and also perhaps comment on the active versus passive debate that Roddy mentioned, and people should look at active management.
Yeah, and I think that's very important to understand. For us, it is vital to really have a framework for what we're thinking about in sustainability, so that when we're trying to identify the companies that will outperform, we're understanding what the key challenges are for the future. And at Lombard Odier, our framework is called CLIck. It's looking at circular, lean, inclusive, and clean economy. We believe those are the 4 areas that really are going to drive real challenges and real change in investment decisions. And it's because we certainly see the need to really identify which companies are positioned to for those challenges. So in certain sectors, we do think time will change, but we think regulation is, as Roddy said, very much driving change. We need to be ahead of the curve on that regulation to understand climate at the moment in the news a lot with Shell and also Exxon and Chevron shareholder actions that are really driving change. That if you don't foresee those coming, there might be investments that aren't in the big oil that might not be sustainable for the future. But it's not just regulation. We're also looking at technology. Where are technology costs cheaper for greener technologies or for more circular technologies? And that's where we can see investment opportunities, whether that be in renewables, driven by technology costs, or as we move forward to new areas, is it in nature and natural capital, because regulation again is pushing more investment into that area. So we follow investment flows, we're following the regulation, where consumer demand is driving opportunities too. So it's across all industries, but I do think when you're thinking about specific sectors, the ones we're really excited about today and where we don't think historically ESG funds are focused on enough are transitioning sectors. Heavy duty industry, absolutely vital for the future, but vital that it decarbonizes. Heavy duty transport equally. So yeah, heavy buildings, greening the building system, multiple sectors of opportunities, but identifying the best in class in those sectors that really will stand to gain in the future.
Okay, thank you for that. And Michael, your perspective when you're analysing companies and performance, looking at it through this lens. Michael, you're just on mute there, sorry.
Yes, I mean, interesting points. We don't look at companies. That's the job that we've delegated down to the fund managers. We do look at funds because we think they're proxies to fund managers. And what is becoming increasingly apparent is the whole range of different interesting approaches to looking at this whole area. So you can be incredibly selective if you want to. And just as a point in the future, because it's that a previous panelist made with regard to the risks and the legal framework, we actually think that there's a significant risk looking forwards to not being ESG, because what will happen is, and we're involved in forensic cases and fighting battles in these sorts of things, that within 5 years, virtually every manager will be having a sustainability screen as the initial screen on any investment proposal. And if you get caught with, say, orphan assets or things like that has been talked about with regard to Shell, I think that we will see legal cases where we'll be challenged, the trustees will be challenged. Why didn't you think of this? This was 5 years ago, this was common territory, and you have not done it. With regard to ourselves, we're developing concepts which mean that we're looking at investments in a different way, and we're trying to look at where momentum is. And I think that point Chancellor Kristina is describing transitioning. We want to see engagement with the companies. A good example is perhaps Nestle, for instance, where Nestle has developed a whole approach to sustainability. It is very carbon intensive at the moment, but an investment in Nestle, who are committed to bringing that down, is much more important than having a commitment to somebody who is already down. There's the complexity, again, of whole life analysis, which we've heard a lot about with Tesla, but even something as apparently benign as wind turbines. For instance, part of the veins are from balsa wood in the Congo, which is not sustainably farmed. Kind of obscure facts like that. We can't be expected to go into that much detail from our perspective. What we're trying to do is pick people who do. And that's the interesting challenge at the moment, is to create the momentum. We get muddled with the word impact, and that also comes out with these definitional terms. Impact is associated with philanthropy at one end. I'm talking about impact in terms of actually what is the impact on carbon footprint as well. And I'd much be more interested in having a carbon sensitive portfolio that was rapidly reducing its carbon footprint rather than one which had already reduced its carbon footprint. And we're trying to get to grips with exactly how to calculate the carbon footprint over a large number of portfolios. And this is a significant challenge. And the better fund managers are producing these figures for us anyway, so we can stick them in the computer. So a different approach. We've got to be dynamic. We've got to be active. I think sitting my endowment into LNG tracker is not entirely, but if it was an LNG, perhaps a sustainable investment tracker, then it might be a good idea. We're fully on side for active investment.
Thank you, Michael. Very, very interesting. Chris, just changing tack. I mean, when you're advising families on succession planning, ultra high net worth clients trying to create a legacy and a narrative around the family wealth. Do you see the investment underneath the structuring that you might put in place, this style of investing fitting well with that, creating unity perhaps across the generations? What's your perspective on that?
Yeah, I think this is an area where this is a really positive angle on the whole topic. We hear a lot, sometimes from me, about the differences between the generations, boomers and X and Z and millennials, and the like, and all these different all these differences in terms of values, etc. And some of it, as always, is cliche, and some of it is rooted in truth. Certainly, it's common when putting together succession planning structures to see these differences in values play out in a very real way, and you may well see the older generation, the wealth creator, who perhaps is more focused on returns and preserving capital, and then a younger generation who perhaps don't wear the wealth so well, perhaps a little burdened by it, having grown into it. Not always, of course, but sometimes that's the case. And who want to do something good with it, who want to use it as a force for good. And we have these conversations around purpose and values, all this type of stuff. And there are people out there, of course, who will write very, very lengthy family constitutions and all sorts, which often then get filed in a drawer and collect dust. But this is something that, you know, people can come together on. It's very real. It's in a simple form, a way of the different generations and their values having their cake and eating it. Because as has been discussed on the panel, it is an area where there are good returns and there are good investments. And it's also an area where people can feel that there's a purpose to their wealth and they're doing something good with it. And the key thing, I think, with succession planning, or a key thing, is communication between different family members, getting them around the table, talking, working together. And an ESG type plan, something in this area, is definitely something that they can come together on. So all in all, I think it's a real positive in the succession planning world. And I'm an advocate for more people, lawyers, trustees, and others who are really in the heart of the succession planning part of the industry, kind of talking about it and thinking about it in this context. The only other thing I would say, though, is perhaps I sometimes wonder whether there are definitely jurisdictional differences in terms of the way that people are prepared to embrace this and the different values in different generations. And so it's not kind of always appropriate. It's not a one size fits all approach for every family from every jurisdiction. And on that, it would be, I know Roddy is a forerunner in the US trusts industry, and it'd be interesting to hear what he sees on this in kind of American succession planning terms, because I'm not sure it's necessarily the same discussion that we're having here in the UK. Sorry, I don't mean to do your job, David.
Roddy, I mean, on that point, how do you see this area developing, particularly, as Chris says, the US market? Very, very interesting to get your perspective. You talked about how long it's taken us and how much has been already written. Where are we going in the future on this?
Well, we have a great let out in most US trusts that we manage, in that they're directed under the statute. And under those circumstances, we do pretty much what the family want us to do. ESG hasn't featured, you're all quite right. And in the Journal of Sustainable Finance, I noticed that the US only scores 14.6 rating on sustainability versus France and Spain, which are up in the upper 30s, lower 40s. So it really sort of hasn't crossed our path that much. We do look after quite a few Americans who live in the UK, and they certainly are more ESG aware. But I think we're all ESG aware. I mean, I am passionate about plastic in the ocean, and I'm passionate that electric vehicles are the worst thing, and we should be throwing everything we can at hydrogen. I mean, I've been to the Congo, I've been on the board of things, I've seen the children digging out the cobalt and all the precious minerals that have to go into these wretched batteries. So, there you are. We have a view. I have interesting discussions with my children around the dinner table. But I always like reality, Chris. And one of the things you've reminded me of is we have somebody who is very, very, she's a life tenant. And for those of you who aren't maybe completely familiar with this in English law, a life interest trust is where the income belongs absolutely to the life tenant. It's not up to the trustee to distribute it. And this person was very, very green. for want of a better word, and then said that I need to maximize the return of the trust. So we started looking, when interest rates were very, very low, at what we could invest in. And well, I need the highest yielding stocks you can find. Well, I can just tell you that when I checked before this meeting, amongst the 5 highest yielding equities at the moment are Imperial Tobacco, now called Imperial Brands, Evraz mining stock, BP, British American Tobacco, and diversified oil and gas. So she had a terrible dilemma that what would give her the best income was absolutely what she didn't want the trust to be invested in. So this is where the trustee has a bit of a wrestle on their hands.
Okay, terrific. And do you think as we go forward, the managers are going to get used to a more nuanced position? As we said on the top, it can be a bit of a blanket approach, so that this is part of the development and people can focus on the issues that matter to the client, tailoring it to what the client's, as always with any good advice, is tailored to the client's interests and needs. Is that where we're going to go to develop this further, is that banks are not just going to talk about it in a blanket way, they're going to get much more nuanced about it, do you think?
Yes, that's where Melanie's going to come in for Equiom. She's going to be our policewoman on this.
Thanks, Roddy. And Melanie, yeah, just to bring you back and just to sort of close off this discussion, we've heard about some of the complexity today, but for private clients who want to look at this more closely and how they start to invest sustainably, responsibly, what would your advice be on how they start that journey?
Sure. So I think I would have to disagree with Michael. I would say, do not let the investment managers drive the agenda. It's absolutely the private clients, echoing what Chris said. I think they need to take a step back, and at a strategic level, what is it that they care about? Again, is it plastic? Is it gender diversity? Is it biodiversity? And that can be really helpful to unite family across generation, as Chris mentioned. But you need to discuss as a family and discuss the governance framework. As has been mentioned previously, no one is against sustainability. It's just that people disagree on the way to achieve it. We just heard Roddy being very anti-electric and pro-hydrogen, whereas somebody else might be pro-electric. And generally, it tends to depend on your view of nature, whether you think nature is perfect and therefore we should interfere as little as possible, organic farming, etc., or whether you think nature is imperfect, it brings you floods and diseases, and therefore you need to improve nature through science and technology. And it's going to very, very different routes. So again, a family may not agree on what is the best way to achieve sustainability, and those conversations need to take place so that a governance framework can be put around this. And then, you know, the whole governance, investment policy statement, family constitution, etc. Then I think it's very important to distinguish between a company's impact and an investor's impact. As an investor, if you invest in the greenest fund where everyone's already super green, and well, your impact is very little. As Kristina mentioned, sometimes it can be about transition, and it's really about what's the best, how can I have most impact? And we've actually seen some beneficiary who decided, having reviewed the whole ESG landscape, and decided to take a distribution from the trust and go the philanthropy route, because they figured that's how I can best have an impact. It's also about, you know, what industry was the wealth created in? Is it in education? Where's my network? Where can I have most impact, and how does that drive the family values? Then I think you need to move down to the implementation level, and there'll be other factors outside of just wanting to do good for the planet. What's your liquidity profile? What's your time horizon? But generally, empirical research suggests that in the public markets, where you can have most impact is through stewardship. So there, you really need to probe on how do the funds vote at the annual general meeting? Are they using a proxy voting? Are they, you know, that's the area where you need to drill down. How are they using their big power to ensure that there's good stewardship there? Whereas in the private market, it's about investing where capital is most scarce. Again, if you're investing in an area where everyone is piling in, well, arguably as an investor, you're not having much impact because everyone's buying into that trade. It's where can you have a big impact and the capital is scarce. Then I would really grill any investment manager on their own credential. Ask them, okay, when you review a company for the ESG credential, what due diligence do you do? What do you look at? You know, your carbon footprint, your gender pay gap, and ask them exactly the same question of themselves. What is their purpose? Who are their investors? How committed are they to ESG? And echoing what Chris said, I think, to that extent, Lombard is very credible in this space. But I do think I have seen some managers shooting themselves in the foot if they were being asked, you know, what do you personally do? I think they would struggle to answer that. And, you know, you don't want this to be outsourced to the marketing department where, okay, what's our purpose? I can guarantee you that if a company is very strong about their own credential and sustainability, it will feed through to the company at every level. Everyone will be clear what is the purpose of that company. So I would just reverse the table a little bit and grill the investment manager on their own credentials.
Okay, thank you. Well, we're going to draw our conversation to a close now, and we're going to cut the